Thank you.
Or there is a pause. Okay, we should. Well, thank you everyone for joining us in this discussion today on collateral mobility. We have an outstanding panel representation here with industry and technology providers. We are going to talk about one of the most discussed topics on tokenization these days, on collateral mobility. I think I'm not going to spend lots of time during the introduction, but because we are going to have this addressed during the questions. Apologies. So I was saying that collateral mobility is a very interesting use case that's been discussed yesterday by Chair FAM during the reception, CFTC, SEC last week during the roundtable, different panels, and this is for a reason, right? So basically, what regulators like about the collateral mobility on chain is the transparency it brings. Giancarlo and some other regulators had mentioned that if they had collateral on chain during the Lehman crisis in 2008, it will have helped, a lot during the insolvency proceedings. But also, what the industry likes is the efficiency gains that moving collateral for making margin calls can provide, and so the operational friction that goes with this moving collateral on chain and off chain. So with this, I think we are going to discuss several how we get there. So how we can make off-chain interoperability among different blockchains, and so perhaps that leads with a question about what are we currently seeing today, real use cases of collateral mobility, as opposed to pilots and in the industry. I'm going to ask the question to all panelists members.
Yeah, so I think tokenized collateral is probably one of the most exciting thing about digital assets. So I'm part of SocGen. We've been active in the tokenization space for a few years now, starting with tokenized bonds, structured products, and more recently stablecoins. I think we did our first tokenized collateral transaction with Maker, I don't know, maybe 3 years ago. So it was us, French bank, doing a trade with a GFI protocol, so pretty advanced at the time. So we basically put SocGen bond as collateral, and we got stablecoins in exchange. So I would say that's the first kind of tokenized collateral transaction that we did. and it's already, I don't know, 3 years old probably, or maybe even 4 years old. With everything that we've seen and heard this morning already on money market funds and the development of these tokenized funds, this will definitely help grow the business on tokenized collateral. On our side, one of the things that we are very cautious about is really the environment on which we will operate, meaning as of today, in order to be able to receive this kind of tokenized securities, you have to go through all of the compliance requirements that you would expect for securities. And it makes the market pretty inefficient today, because everyone needs to be part of the same ecosystem where everyone's comfortable with everyone. So it's pretty fragmented. But I guess one of the questions later on would be how we move forward.
Hi everyone, I'm Natasha Benson from Onera. We provide interoperability to blockchains and networks to allow for tokenized assets to move for collateral. The question about where do we see the most value and what are the production use cases at the moment, I think we're really starting to see this momentum build. Just a couple of weeks ago, we saw the DTCC come out with a great collateral experiment. That was actually powered by Onera. So we actually facilitated that interoperability movement between chains. We've also seen leaders like JP Morgan come out with their own TCN network, which also allows collateral to move between participants. We've seen Calastone also recently talk about their own collateral project as well. So it's all coming together. We've also got projects coming to market, such as JP Morgan's Project Prince with HQLX, where we're actually moving collateral real-time intraday between market participants. So I think no longer is it a POC or a pilot project, it's actually coming to production and we're seeing real utility value.
Thank you.
Hello, everyone. Thanks for coming. My name is Jay Hu. I'm an MD from Moody's Ratings Structured Finance Division. I manage all the CLOs and asset-backed securities. Also sit on the leadership team for digital economy, decentralized finance team. Also on the leadership team for private credit. We've actually seen several real use cases. We rated quite a few vehicles, including digital CP, including tokenized funds. Most of the assets are short-term treasuries in these funds and CP. T-bills, some government bonds, and in some cases we've seen inquiries on demand deposits. So it is clearly a growing space, and Moody's Ratings service have been requested in many such cases.
Great, thank you.
Hi, my name is Ajit Tripathi. I have a background in investment banking, Goldman Sachs and UBS, and then I went to work on the deep end of cryptocurrency at Binance and Aave, and later on at Polygon and now Avail and RootVX. So we believe that everything will be tokenized one way or the other, and so today capital markets are very fragmented, mainly by regulatory domains. And with the crypto industry, what we have seen is the internet native capital markets, which are seamless and permissionless. And obviously the permissionless world of crypto doesn't naturally fit into the the KYC and AML regime and the complex post Dodd-Frank risk and regulatory regime. But I think now these two worlds are essentially coming together because fundamentally there is a deep search for yield. There's a lot of yield in private credit assets, various private equity assets, and so on. And the world of crypto that's been growing extremely quickly wants to access this yield, and tokenization offers a solution. I used to work in tokenization for consensus. We were too early, and we were pushing on efficiency use cases. What we learned later is that efficiency is nice, but what is much more exciting for bankers is the opportunity to make money. and not a surprise. So now I think we are looking at use cases finally where this yield becomes accessible to a very fast-growing world of crypto, but also private equity and other assets in the traditional finance world can get distribution. So we are quite pushing on distribution as well, and more on the revenue-producing front office applications, because they are much more exciting to the industry than the efficiency users.
Thank you, Ajit. So moving to off-chain, on-chain collateral management systems. So what infrastructure is enabling real-time collateral transfer today and connecting with traditional collateral management systems do you see? Perhaps Natasha and Ajit can...
Yeah, sure. So it's a really interesting question, and I echo Ajit's point about this utility of tokenized assets really landing with liquidity products, because it has a direct P&L impact to traders. So we're seeing a movement into that space, or certainly acceleration in the space, because there is a benefit, is a tangible P&L benefit. So in order to realize that benefit, you've got to make the assets mobile. It's no good having a walled garden where you can move between A and B, but when you want to move it to C, you're stuck. It also extends to Ajit's point about KYC AML. It's got to have that flexibility to move like a security. If you look at the world today, when we're moving assets as collateral under a CSA, it's very manual. It's done through clearing systems. It takes 2 days, 3 days to actually settle that collateral. And you've got operations teams powering the back end of that to actually get it done. I always remember in the financial crisis a long time ago, trying to move a government bond to cover exposure I had against a transaction, and my ops team didn't want to do it because it was painful. But actually for me as a trader, it was super efficient and actually saved me a lot of money. So yeah, that's what we're seeing is the benefit in enabling this real-time collateral mobility. But we've got to do it in a way that is interoperable, and this is where Onera comes in. We've developed a solution called FinP2P with the industry, and 80 different participants actually contributed to designing something that works like the internet, that allows for a protocol to move between different blockchains. So it doesn't really matter what blockchain you issue on. It doesn't mean that you as an asset manager have to issue on every single blockchain out there, because that would just be a nightmare. It means that you can issue on one blockchain, have one kind of golden source, one record, but then allow that to move into different environments. And that, if you're on the buy side, if you're a trading desk, if you're a collateral receiver, doesn't mean you even need a blockchain. You just need to be able to have a wallet that allows it to move between participants. So we're actually powering 2 experiments at the moment, and I know we didn't want experiments, but it's the starting point to actually going to production. But 2 experiments, one in Europe, and then obviously the DTCC project here. In the European experiment, we're actually bringing together lots of banks to actually move collateral between different environments. So not just in one blockchain, so we've got public and private blockchains. We're allowing them to move those securities, and we've got different types of assets coming through as well. And it's really good to see the market coming together and seeing this utility value.
Thank you, Natasha.
Yeah, so there's a lot of expertise here on the permissioned regulated side of the world, so I'll try and represent more of the cryptocurrency industry. So what we are seeing is more of SocGen-like experiments where you essentially lock permissioned collateral and issue permissionless stablecoins on a public blockchain. So what that does, so it's quite a fortunate happenstance that the US has a strategic objective of exporting the US dollar worldwide, and therefore there has been a lot of, I think, willingness to forego the BSA rules, essentially, as long as you see like $240 billion worth of stable coins, and they're not necessarily moving within a KYC'd regime or necessarily in compliance with the traditional AML rules. And the motivation behind that is geopolitical, because US sees permissionless blockchains as the Belt and Road financial infrastructure for the US dollar. Now, at least that's my view. So now I think that creates a very interesting opportunity, because this internet native finance of the crypto world is essentially has all this DeFi or decentralized finance opportunities. And the way you, now obviously if Apollo wants to access that, then one way to do that is to lock permission collateral in a protocol like Aave, and then issue a permissionless stablecoin like Go on a public blockchain, and that goes around all over the world. The other way is to create interoperability between DeFi, which is, let's say, an Aave or Morpho-like chain, and then in a permissioned, compliant environment like RootVX's tokenization environment, you can essentially give access to these permissionless stablecoins, access to, let's say, Apollo's accred yield, or some of the GPU data center type of tokenization yield. So there is a lot of opportunity to bring these permissionless and permission worlds together, and the collateral is mostly coming from traditional financial assets that is looking for new markets, new distribution, and then stable coins become this interesting lending mechanism for this collateral to access this wider internet financial system.
Thank you so much, Ajit. So moving quickly to cross-chain mobility challenges, and so what are the current limitations that you see around liquidity, fragmentation? Perhaps Charles, do you want to add a word?
Yeah, sure. So I'm going to take a different angle here, more as a stablecoin issuer, not in the US, disclaimer for my compliance guys. So we do have stablecoin outstanding in Europe, and as Natasha mentioned, these kind of initiatives from Onera are really key in the markets to allow issuers to go from one chain to another without onboarding all of them. We've been looking at different solutions, like different protocols that offer this kind of trans-chain communication. We've had, I mean, our IT team had some interesting experience where you want to transfer one token to another. It can be burnt on the first chain, but then it fails on the new chain. So basically, you end up losing your assets. And that's the kind of, I would say, new analysis that we are performing on our side, and that's why I would say solutions like Onera is really promising. Another thing that we are looking at for tokenized collateral is working with the tokenized funds that are looking for financing over the weekends, because most of them are still buying, I would say on their asset side, they're still buying traditional securities, traditional US treasuries. And so during the weekends, if they face redemption, well, they cannot liquidate them and they still need cash. And so as a bank, we do fund financing, and having a credit line 24/7 to help them processing redemption is a good and interesting use case for us and for them as well, and for ultimately investors. The last piece that we are looking at is I would say a global initiative called Global Layer 1 that was launched by MAS from Singapore with a few big banks. The idea is to have, I would say, a network of regulated intermediaries that will be able to transact between themselves. The way I see the future is kind of this already exists in the DeFi world with Aave and other very smart protocol. We need to see this happening for institutional applications.
Want to jump in?
Yeah. So honestly, on the institutional point, we see tremendous value there in mobilizing collateral for institutions. Yes, we can do it in the DeFi space, but actually, really, we want to do it in the TradFi space. And so what we're really trying to articulate through the working group and GDF has pulled together is the structure around collateral mobility. Like, what does it need to look like? Do we understand the tokens that are being issued well enough? So is everything the same? And actually, when you get into the detail, they're not. So what we're trying to do through the GDF is establishing some guardrails around the assets. So is it digitally native? Is it a twin? Is it a representation? And you've got this kind of spectrum of different asset types before you can even then look at, does this asset move? So then when you look at the asset moving, we're looking at, can it be rehypothecated? And what does that mean? It means that I can transfer it to you, and then you can transfer it to somebody else. And at the moment, that doesn't happen. So there's a real inefficiency in the way these have been created because they lock them into the walled gardens. So through the GDF working group, we're actually trying to expand that out and look at how do you move it across different networks. What's the legal regime in which you actually move it, and do you have good enforceability? And so I'd welcome anyone to join the working group, because there's a lot of really rich information that's coming out of it to actually say this is the way you do it. And in that working group as well, we're doing a sandbox to actually test between participants using real money market funds that have been issued and saying, okay, we're going to move it between A and B, and then between B and C, and then actually look at the redemption. On the redemption use case, you're quite right, Charles, that cash is the problem. Like, cash is still moving in an old school manner. So one of the use cases that we're actually bringing into the sandbox is a redemption both against USDC and then also redemption against Finality Cash. And some of you may be aware, Finality is going for their US dollar license. When that comes through, then there'll be an ability to settle on-chain 24/7, and that's a game changer for the banks receiving this.
Great, thank you very much. So moving quickly to risk management and frameworks, are we seeing any regulated entities adopt risk management frameworks or maybe tailoring them to the new technology? Perhaps, Jay, you can say a word.
Yeah, sure. There have been a lot of development progress made in the risk assessment management framework with respect to blockchain-based transactions. To go back to the use case, real transactions we rated, you think about the assets being treasuries or government bonds, highly rated. But when we rate them, we rate to highest AA, sometimes BAA. And why? Because we have to assess the risks involved in these transactions. We look at the risks from two large buckets of them. One is around the things that are based on the platform. So platform risk, smart contract, asset representation, and then external risks. So things like, are there any potential malfunctioning? Are there any design, if there's a design issue, is there error correction with respect to platform, the smart contracts? And if there are transfer rights, property rights, are the credit rights protected? And external risks, things like cyber risk and legal and regulatory framework and changes. A lot of panelists in the previous sessions that people have talked about. But on top of that, a lot of the risks we assess are very similar to those risks that we have been looking at in structured finance, things like counterparties. You have managers. Do managers have a great good experiences and track records in managing these assets, even though they are like U.S. Treasuries, sound like safe, super safe, but it could be in the wrong hands in terms of who's dealing with it. So having experienced manager is quite important. And then on top of that, you need to make sure you have a right calculation aging and collateral aging, making sure that all the funds and receiving and the purchases, those are done properly. So when we rate these things, we look at all these aspects of risks, and then we come to a conclusion. But most of these we've rated AA investment grade, rated funds and the CPs. So those are the risks that we look at.
So I'll just take that for a second, right? So in the world of permissionless blockchains, the joke goes that there is no risk, right? So as in there are all kinds of assets that we trade day in, day out, and they're used as collateral in multiple DeFi protocols and so on. But in spite of all that, DeFi has proven itself to be quite resilient. Aave is still standing in spite of violent market moves. Maker is still standing. So DeFi has been quite resilient, and it's part of that is because of transparency and the fact that assets are native. But there is a lot of opacity in the traditional finance world that's deeply buried in CSAs and legal agreements. That is just assumed to not exist in the crypto world. But once we bring, let's say, tokenized assets into the DeFi world, then I think we will really have to look at all of the details, the legal and operational risk aspects. And in crypto, no one knows that there is a Basel III or Basel IV. So, so I think it'll be very interesting to see how these worlds come together.
I think that also extends to the work we're doing on the Collateral project, because actually what we've seen is these instruments don't behave in the same ways. And actually in the DeFi world, they don't actually know that they don't behave in the same way. So I think there will become a need for the DeFi world to start investigating more and understanding what they're buying. And this is where you come in.
Yeah, just to add something, in terms of risk analysis of these tokenized assets, I mean, when we started working on this 6 years ago, we published what we call the CAST framework, which is basically how we see tokenized securities work on chain. More recently, DTCC did a great job with control principles on digital asset securities to give a framework on what kind of risk you should be looking at and give you ideas on, in terms of for your different internal control teams to look at digital assets. And then it comes down to really simple questions and matters that you have to discuss with your clients. I mean, we don't see that many tokenized collateral yet because outside of the money market funds, other securities are not that easy to issue on chain. If you look at how do you manage the maturity of a bond on chain, it means burning the token potentially automatically, which is not something that you should be doing on a chain, or do you force the transfer from a wallet back to the issuer for maturity, which is, again, not something you should be doing probably on a chain where you force a transfer on asset from a wallet. Same for coupon payments. How do you manage coupon payments if the tokenized bond is put out in an AAV pool? What's the tax status of a AAV pool? What's the withholding tax for the paying agents to process this kind of payments? So this triggers a lot of very interesting questions that everyone forgot about when you're dealing with traditional assets, because it's within very standardized process, but we need to ask these questions again in this new environment.
I think we touched upon all the questions related to on-chain, off-chain, interoperability across different multiple chains, and perhaps also creating standards and risk management for this type. So in the interest of time, I'm going to stop here. Thank you very much, all.
Thank you.